Today's highlights: funds are pulling out, institutions are on the sidelines. Will the Federal Reserve turn dovish to save the market? Has the halving effect lost its power? Can Bitcoin really reach $150,000 in the era of institutional investors? BFC fiercely criticizes MSCI. Should companies keep accumulating coins or risk being marginalized? Tuesday, December 9th. This is the BitcoinTV Chinese channel, Be United, greeting you from Abu Dhabi. We're reporting live from the Bitcoin conference. Let's first look at the most important data headlines from the past 24 hours. According to the crypto data market platform Sentiment, although Bitcoin has been fluctuating around the $90,000 range, the on-chain data structure remains very stable. Over the past year, a total of 403,200 bitcoins have flowed out, reducing the overall supply by 2.09%. This means that the market is actively withdrawing from exchanges, reducing selling pressure. In sharp contrast to this ongoing decline, ETF inflows have come to a standstill. Funds continue to flow out, and the pace of new capital entering the market has currently slowed down. Institutions are generally waiting for guidance on interest rate cuts from the Federal Reserve. If the Fed adopts a hawkish tone, the market will enter a phase of short-term volatility and speculation. If the Fed continues to send dovish signals, it will accelerate the path of rising crypto prices, and incremental capital will quickly flow back into the crypto market, reigniting the liquidity cycle. Therefore, the weakness in ETFs seems more like a period of silence before policy changes rather than a reversal of the trend, and the true direction of the market still lies in the hands of the Federal Reserve. All right, there's another very interesting piece of data. Small investors holding less than one Bitcoin, whom we call shrimps, have been unusually quiet lately. The amount these shrimps have deposited on exchanges has dropped from 2,675 Bitcoins after the FTX collapse to just 411 Bitcoins now, a direct evaporation of 60%. This isn't just a matter of low spirits, it's been a steady outflow for 2 whole years. But what's strange is this: while Bitcoin has been hitting new highs, the small retail investors haven't been replenishing. So when was the real turning point? It was in 2024 when the ETF was launched, allowing retail investors to directly and effortlessly buy spot Bitcoin ETFs without having to deal with exchanges or mnemonic phrases anymore. In other words, small retail investors haven't disappeared. They've just become more mature. Everyone now knows not to overcomplicate things or trade too frequently, and the main strategy is simply to hold long-term and not move. This wave of silent retail investors has actually made Bitcoin more stable, with less selling pressure and stronger hands holding the coins. Now let's take a look at the on-chain data for Ethereum. This round of data has directly flashed a red warning light. As you can see, on November 23rd, there was a single purchase of 877,300 ETH worth about $2.5 billion, which was swallowed up in one go by a whale and sent straight into an accumulation address. It's as if they wrote 8 big characters on the blockchain, $2,800. This is my territory now. So accumulation addresses are often understood as black holes in the crypto world. Once Ethereum goes in, it basically never comes out again. So after nearly 900,000 ETH were sucked in, it means the market's selling pressure instantly shrank and the supply immediately tightened. What's even more coincidental is that the average cost for long-term Ethereum holders is right at the $2,800 level. So $2,800 has already become a short-term support. It has now become the stronghold of long-term Ethereum consensus. As long as market sentiment warms up even a little, then $2,800 is very likely not just a support level, but the starting line for the next rally. All right, please like and turn on the notification bell. I'll help you sort through the latest news from the past 24 hours in the crypto, blockchain, and mining circles, news that's closest to your wallet. We're here in Abu Dhabi at the Bitcoin conference, and right now, mining is still the cornerstone of the entire Bitcoin conference. Although Bitcoin's hash rate keeps rising and miners' income keeps decreasing, we're seeing all the major mining companies here are still fiercely competing. So the heads of all the major mining companies have made it very clear. There is a consensus among everyone that the current market is not being driven by miners nor by retail investors, but by institutions swiping their cards. ETFs are drawing all the attention, and big players, along with long-term holders, are steadily building their positions. So the current price logic of Bitcoin is more like the more capital flows in, the higher it goes. To put it simply and bluntly, the halving is still happening, but the steering wheel has already been taken over by institutions.
Bernstein pointed out that in the past few months, Bitcoin has pulled back nearly 30%, but the net outflow ratio of ETFs is still below 5%, performing better than market expectations. This shows that institutions now view Bitcoin as a strategic asset allocation, rather than a short-term speculative product. MicroStrategy's latest increase in holdings further reinforces this assessment.
And the difference this year is the participation from listed corporations like MicroStrategy and its copycats, who are really driving the equity capital markets right now, which are wide open for crypto strategies, and that's been the hottest part of the market.
As a result, Bernstein has raised its price target for Bitcoin, predicting that BTC will rise to $150,000 in 2026. And in 2027, it is expected to peak at $200,000. If institutions continue to expand and ETFs systematically build positions globally, replicating sovereign wealth fund strategies, then Bitcoin's long-term potential ceiling could rise to $1 million by 2033.
So as you can see, in the past there were companies and experts predicting that Bitcoin would reach 200,000 to 250,000 by the end of this year. But now, this report is essentially telling the market to stop fixating on the so-called myth of Bitcoin's 4-year halving cycle. The driving forces behind Bitcoin's price have already shifted to ETF capital inflows, institutional positions, future interest rate trends, and the maturity of regulatory frameworks. So once long-term capital enters the market steadily, the price action won't be like the roller coaster cycles of the past. Instead, it will be more like a long, gentle slope, where the snow gradually accumulates. So if the institutional era really raises the ceiling for Bitcoin, then Bitcoin will no longer be just a speculative toy. Instead, it will become a strategic, legitimate asset that sovereign wealth funds, pension systems, business owners, and centralized government institutions will all compete to allocate. Have you noticed that Michael Saylor, the die-hard Bitcoin bull and CEO of MicroStrategy, is now giving passionate speeches and making frequent appearances at various Bitcoin conferences in Asia and at Bitcoin events like MENA? Do you know why? He has to raise funds. If Bitcoin's price drops further in this cycle, MicroStrategy could really face a crisis. So in this round, MicroStrategy really can't afford any black swan events. Let's hope Michael Saylor can hold on. All right. Right now, I'm in Abu Dhabi at the Bitcoin MENA event in the Middle East. This conference, it's being held on the 8th and 9th in Abu Dhabi with about 12,000 attendees. The discussions are all about Bitcoin, institutional capital, and innovative management systems. Abu Dhabi has an ambition to let the whole world know. In terms of computing power, mining, sovereign adoption, and regulation, Abu Dhabi is at the forefront of the industry. As a result, on the very same day, or the day after, the Bitcoin MENA event kicked off, a new regulation was introduced. In other words, if a treasury company has more than 50% of its assets in digital assets, it will be kicked out of the index, forcing many companies to reduce their holdings in you. So it's almost like they're putting a damper on the Middle East Bitcoin conference.
According to the latest proposal from MSCI, as long as a listed company's digital assets account for 50% or more of its total assets, it may be removed from traditional industry indices or reclassified as a digital asset treasury company. The Bitcoin Alliance BFC has strongly opposed this, arguing that such a move deviates from MSCI's long-standing principle of classifying companies based on their actual business activities. They also believe it will bring structural distortions to the global index system, thereby affecting companies' capital cost valuations and shareholder equity.
So MSCI's stance is very clear. They don't care what your company actually does, but as long as your Bitcoin or digital asset holdings exceed 50%, they'll classify you as a fund-type enterprise. As for what your traditional business really is, they can simply ignore it. In the financial world, this is considered a highly controversial move. It's completely at odds with Trump's fundamental policies. So if a listed company's industry classification is based not on what you do, but on what your assets resemble, then this will cause many companies that are hoarding coins to not disclose their Bitcoin holdings, and the path for companies to adopt Bitcoin will be forcibly cut off. This counts as the biggest piece of negative news from this Bitcoin conference. The myth of getting rich overnight, as well as carefully orchestrated scams, both exist here. This is a place of chaotic development, a dark forest. Yet here too, the spark of hope leading to the light is being nurtured. The destination of faith is freedom, and the endpoint of consensus is equality. This channel will guide you through the fog, help you see the future, and together we'll gradually become wealthier. Lock in 4 major opportunities in 2026. Can you really catch the next bull market? Argentina's regulators are reversing course, and banks will allow cryptocurrency trading next year. Is this really true? At this Bitcoin conference, we discussed the future trends of the crypto world with many industry OGs. It seems like everyone shares a common sentiment. We're always losing money, losing in the bull market, losing in the bear market. Why is that? A bunch of worthless projects with no real products and sky-high valuations have drained all the liquidity from the space, and they've made outsiders think the crypto world is just a gathering place for scammers. What's even more outrageous is that everyone feels like after these scammers have fleeced the newcomers, they just convert the money into fiat assets and never bring it back into the crypto space. So long-term players are getting burned so badly that they're starting to question everything. But don't be too quick to draw conclusions. This isn't the final chapter for cryptocurrencies. It's actually the prelude to cleaning out the trash. You can think of 2025 as the year when all the trash projects get cleared out, but good projects are still holding strong. Hardcore players like Hyperliquid and Formal Up are still here, showing everyone that those who are serious about building are still thriving in the bull market. They won't be dragged down by worthless coins. Only by taking out the trash can the industry move forward faster. Banks are not going to launch stablecoins.
If the Genius Act is not legislatively passed, this marks a turning point for the industry, with stablecoins, Perpendex, and DAT forming the three main pillars. The Genius Act will be implemented in July, establishing a 100% reserve requirement for stablecoins, which is expected to drive a net capital inflow of over $100 billion. Stripe's acquisition and Circle's oversubscribed IPO both demonstrate strong institutional confidence. PerpTX is booming, and Hyperliquid, now without KYC and offering high liquidity, is challenging centralized exchanges. HKEX. The buyback mechanism is reshaping valuations, with August revenue alone reaching $106 million. Although DAT has receded in popularity, its total holdings of $137 billion still provide traditional finance with a window into crypto.
So by 2026, don't wander aimlessly. There are a few key sectors that, if you focus on them, are guaranteed to be wealth generators. The first is the prediction market. For example, Polymarket has already received investment from the New York Stock Exchange, right? Its valuation has reached $8 billion. The second is the stablecoin payment sector, which is definitely the throne, the concrete pillar. Visa and MasterCard have already jumped in. And speaking of stablecoins, China has already classified RWA stablecoins as a priority. They consider it a factor affecting financial stability or even label it as illegal financial assets. Now, the only legal channel left to convert stablecoins or digital assets back into RMB is MyPay. MyPay is the only legitimate way to cash out, one that won't get your card frozen or draw regulatory scrutiny. So, after China intensified its crackdown on cryptocurrencies, MyPay's transaction volume in RMB has quadrupled in a single day. Let's take a look at Argentina. In the past 2 years, Argentina has basically been forced into the crypto world. Why? Because their fiat currency, the peso, changes value every single day. It keeps depreciating, and when you wake up, it's already lost value. So what happened after the data came out last October? The amount of money Argentine users poured into cryptocurrencies directly surpassed Brazil, firmly securing Argentina as the #1 crypto country in Latin America, and its usage rate is also at the top in the entire Western Hemisphere. Ordinary people are treating crypto as a necessity for survival and protecting their money. This is not an exaggeration at all. What's even more surprising is that the government, which used to strictly regulate cryptocurrencies, has started to loosen up. This feels a bit like how they used to ban it, but now they're being forced to give it another try.
According to a scoop from Argentina's La Nación, the central bank is currently discussing a policy to allow traditional banks to enter the crypto trading business, which could be implemented as early as April 2026. This means the regulatory stance has made a complete 180-degree turn. Previously, regulators had cracked down hard. In 2023, the central bank banned payment institutions from offering crypto services, and in 2022, when two major banks announced they would open up digital asset trading, the authorities quickly put a stop to it. The reason given was that it endangered users and the financial system. This potential easing is seen as a major reversal signal from Argentina's financial system regarding crypto assets.
Do you think the Argentine government suddenly had a change of heart and was forced to open up this time? In fact, the government had already paved the way for regulation. Back in March, the regulatory authorities had already laid out rules for crypto asset services, clearly specifying how each service provider could obtain licenses and operate with proper certification. So once the rules were set, everyone saw Coinbase come in, Binance come in, Bybit come in, and the Argentine market suddenly took off. The local Argentine exchange is called Lemon, and they made it very clear. They said that only an open financial environment can truly allow cryptocurrencies to become integrated into the daily lives of ordinary people. And what I want to say is that cryptocurrency is the trend of the entire industry, especially stablecoins. Those who embrace it will gain an early advantage, while those who try to resist it will eventually be swept into the dustbin of history.
An American woman was scammed out of nearly $1 million by a pig butchering scheme. In the end, it was only after she asked ChatGPT that she realized she had been conned. The scammer played their role like a pro. But in the end, it was exposed by AI in just one sentence. The crypto world is so chaotic that even AI is forced to play the role of the police. With just one statement, Trump set the tone. H200 chips can be sold to China, but each one must pay a 25% toll first. This time, the US turned the ban into a toll booth, not fully open, but definitely not free, completely redefining its chip policy. A new model has been established where access is possible, but comes at a price. Vitalik Buterin, the founder of Ethereum, put it bluntly. In the past, the Ethereum Foundation's network layer was a weak spot, but now with this move, that shortcoming has been addressed. Finally, it's no longer like running with just one leg. Recently, a tough player named Pony has emerged on Polymarket, specifically betting on OpenAI-related news events, and hasn't lost a single time, maintaining a perfect 100% win rate. He's practically the Elon Musk of the prediction world, a true trendsetter. So far, he's already made about $77,000, relying entirely on news-driven strategies to dominate the field. The data from cryptanalysis is a bit alarming. The number of active validators on Solana has plummeted from over 2,500 in March 2023 to just around 800 now, a direct drop of 68%. It's hard not to start questioning whether Solana's engine can really hold up.
Remember, anyone who has survived in the crypto world for more than 3 years has definitely been schooled by the trends. You might get lucky with short-term guesses, but to really make big money, you have to follow the trend and go with the flow. Trends are not meant to be fought against, but to be followed. Many people lose money not because they picked the wrong direction, but because their mindset is even more stubborn than the trend itself. In an uptrend, they're afraid of buying high and don't dare to enter. In a downtrend, they're afraid of losing and don't dare to cut their losses. The harshest truth in the market is that you can be wrong, but you can't be stubborn. When a trend comes, you can't stop it. When it leaves, you can't make it stay. So truly outstanding traders are not those who can predict the future, but those who can admit they're wrong at the first sign of a trend reversal and go with the flow. Trends never lie, but they do punish the stubborn. Remember this phrase and keep it close to your heart. Following the trend is how you make money. And the closed door sessions are just paying tuition to the market. All right, that's all for today's program. We hope you'll consider becoming a member. Here you'll find all the member benefits. We want to guide you through this bull market to grow together and gradually become wealthier. See you tomorrow.